Good morning, it's Jeff Christian. It's the 5th of February, Friday, in New York, about 11:15. I wanted to talk a little bit about our expectations for gold and silver prices, and then if I have time, I'll go into some other subjects. CPM Group has been saying for some time that we thought that the prices of gold and silver in 2021 and 2022 could be relatively muted, that they would be rising, but not at the fast pace that we saw in 2020. Our expectation was that 2020 was a really bad year politically, economically, in financial markets. You saw a tremendous resurgence in investment demand for gold and silver after several years of relatively low demand, and in fact, some investors selling gold and silver. Our expectation was that 2021, 2022 would see a modest recovery economically and some stabilization in the political environment. Still massive monetary accommodation as well as fiscal stimulus that would help overall economies. And in that kind of environment, maybe gold and silver continue to rise because none of the big problems are being solved. They're just being pasted over and dealt with. But that you could see gold and silver rise, but rise much more modestly this year into next year. But that at some point, those big problems come home again, and we have a much more severe economic and financial market crisis like we saw in 2020 and like we saw in 2008, 2009, and that would drive gold and silver prices sharply higher. We still hold that view. We haven't seen the kind of price strength in January that we had expected. You have seen some pretty strong upward moves and the prices have been relatively strong, but you've also seen some weakness. So the first quarter seasonal strength maybe isn't evolving the way we had expected. January is usually better than February and March, I think, but we'll see how it goes. And then usually second and third quarters are seasonally a little bit weaker. That seasonal pattern may still hold, but it may not because, as I said, those economic and political conditions still are there. We expect some improvement, at least modestly, economically. The jobs reports from the United States Labor Department today kind of points in that direction. Modest improvements in economic conditions, financial monetary accommodation continues. Maybe some improvement in the political environment in the United States, but still very hostile international relations. Tough time. So our comments with our investors has been, yeah, from a long-term investment perspective, the second and third quarters may see some interesting times to load up on gold and silver, but given the price declines that we saw yesterday, it may not be too bad if you buy in February or March. That's our basic view. I think that gold below $1,800 is a good investment from a longer term perspective. Silver below $26.50 is a good purchase. And if investors want to wait, they might see better. They might try to ladder in and do a little bit buying on dips in the first quarter with the expectation that they can buy more in the second quarter. Second topic I talk about is market manipulations. We're continuing to see comments about, well, the JP Morgan settlement. And I started off, I've been in this business since the 70s, and I've seen the rise of gold and silver conspiracies. And it starts with big cap conspiracies. There's a global cabal involving central banks and the Fed and highest level of officials and all kinds of banks, and JP Morgan is in there and all kinds of other folks. And then you see that there's no evidence to that. And you see there's a tremendous amount of evidence that such a cabal does not exist. So the guys who market conspiracy theories, like the Asian who actually is behind QAnon, they say, well, it's not that big of a grand conspiracy, but there's a conspiracy. And they trot out car leasing agents who say that they work for J. Aaron, but they didn't, to pretend that they know about this conspiracy. And that doesn't really show up. So they say, well, yeah, but people manipulate markets. And they do. all markets are manipulated. And in fact, all human activity is, if you want to take a really accurate definition of manipulation, all human interaction is a manipulation, right? And then you have spoofing. Around 2000, 2002, I actually spent some time with some people in the stock market who were talking about the movement from stock trading away from floor trading to electronic. And the big problem with electronic trading across markets is you don't have market makers and you don't have the stops that you do in floor trading. And there were people on the floor of the stock exchange whose job it was to make markets. And sometimes they took it on the chin. After 9/11, when the market reopened, computers were down, people didn't have records, there's massive selling, and those market makers were buyers. They were the only buyers in the market for a few days, and they really ate big losses. They did that because on the long run, being on the floor of the stock exchange, they saw stuff a microsecond or a second or a minute or 5 minutes before everybody else. And that gave them the opportunity day in, day out to trade more effectively. And they did very well for themselves that way. And as a result, they made money, and they had that money in the bank to cover their losses when bad things happened and they were taking it on the chin. There's a great story about Bernard Baruch, who is a very good investor and very intelligent person. And he got wind because he had good connections in London and in Paris. He got wind that World War I was starting. He got wind over the weekend. So he came to New York to wire, to send telegrams from his weekend place, to send telegrams about what was going on and to sell stock in London. And afterward, people said, well, he was trading on inside information. So now he got a piece of news from Europe. There's spoofing then. Now, look at JP Morgan and the settlement. And my understanding, I don't spend a lot of time on it because this is all a giant distraction from what's really important. But when you look at these settlements, most of the settlement is for non-supervision of traders, what we call Wall Street bros. People who sit on the floor or sit on the phone, or now they trade electronically with each other, and they're spoofing and there's diddling around in the markets. And that occurs, as I said, in every market. It occurs at Hunts Point where you're buying vegetables wholesale. It occurs in the stock market, bond market, currency markets, precious metals. You look at JP Morgan, most of what they were found was those Wall Street bros diddling around in the market, spoofing the markets, and JP Morgan wasn't really supervising them properly. And most of what they found was in fixed income and currency markets and stock markets, as opposed to gold and silver. Gold and silver are a smaller part of the financial markets everywhere. Several years earlier, one of the first big settlements was Barclays Bank. You had an option salesman who actually placed some orders because he was trying to keep the options price from moving against him in the favor of one of his clients. And he wanted those options to expire worthless because it would be more profitable for him and less profitable for his client. So he put in some orders to try to keep the gold price from taking those options into the money. He was found out. He was fined. Barclays was fined for non-supervision. In the investigation, they found that the bullion desk, which this guy sat a few feet from, was unaware of what he was doing. So when you start talking about conspiracies and collusion and manipulation, within Barclays, this guy wasn't even conspiring with his own desk mates, let alone other banks. And that's what you find over and over again in these markets. It's very important to understand that. There was a guy in the 1980s who was a broker in Florida for Drexel Burnham. He got caught manipulating and doing improper trading in the frozen orange juice and concentrated orange juice market. He tried to be good to the CFTC and said, look, if you're nice to me, I'll tell you some things that Drexel's doing in the silver market. And they said, show us what we got, show us what you got, and we'll see where it goes. He showed them what they got. They investigated Drexel. They found two off-market trades that were then cleared on the futures market, where Drexel was actually hedging its book. At the end of the trading day, it had a mismatch. And so it went to another company and said, listen, I need to buy X ounces of silver from you today at this price. And then tomorrow morning when COMEX reopens, we'll clear it. So it's interesting because what they found with Drexel was in fact evidence that Drexel did not have any naked positions in silver. It was trying to hedge its book at the end of the day, but it was doing it in a way that was improper in the 1980s. So he was banned from futures options, being a futures merchant. And he started all kinds of rumors that Drexel was diddling with the silver market, suppressing the price. He wrote letters to Attorney General of the United States at the time. He wrote letters to the governor of Idaho and the senators from Idaho and the executives at various silver mining companies. He still is doing that. Drexel went out of business in the late 1980s, and he said, okay, it wasn't Drexel, it's Merrill. Merrill got out of the precious metals business in the mid 90s. He said, no, it's not, it wasn't Merrill, it's JP Morgan. And people believe him. I can't understand people's beliefs. I don't know what it is. Wrapping this up, a few more words about the what went on in GameStop, AMC, and silver over the last few weeks or so. We're starting to find evidence, and you'll see more when the COT, the Commitment of Traders, comes out for silver later today, the roles of institutions. You know, we are already finding that a lot of the buying in GameStop was coattail riding of the Wall Street bets people by large institutions, and that institutional investors probably made several $100 million last week riding the effort to pump up GameStop. We're also seeing that a lot of the buying in silver, futures and options, was in fact institutional investors watching what these guys were saying they wanted to do and taking advantage of it. And then, as we say, and we pointed out in our precious metals advisory that came out yesterday, we explained it a little bit better. Insofar as these people think that they were trying to hurt Wall Street, they actually didn't, because banks and dealers make their money by charging interest rates on fees and service fees for buying, selling precious metals, for leasing metal out. And when the price is higher, those fees, which tend to be percentage of the value, are higher. So it was a good time for Wall Street that these guys came in there and did that. And it wasn't particularly damaging, except that it showed flaws in the stock market. That's all I have for now. Have a good weekend. Stay clean, stay safe, stay warm, and we'll talk next week.